The world's financial system teetered on the edge again last week, and anyone with more than a passing interest in their shrinking 401k knows it's because of a global credit crisis. It began with the collapse of the U.S. housing market, and it's been magnified worldwide by what Warren Buffett once called financial weapons of mass destruction. They're known as credit derivatives or credit default swaps, and we did a story on the multi-trillion-dollar market 3 weeks ago, but there's a lot more to tell. Essentially, they are side bets on the performance of the U.S. mortgage markets and the solvency of some of the biggest financial institutions in the world, a form of legalized gambling that allows you to wager on financial outcomes without ever having to actually buy the stocks and the bonds and the mortgages. It would have been illegal during most of the 20th century, but 8 years ago, Congress gave Wall Street an exemption, and it's turned out to have been a very bad idea.
The term derivative is almost becoming a household word.
The cat's kind of out of the bag here.
This is not the American dream. It's an American nightmare.
While Congress and the rest of the country scratched their heads trying to figure out how we got into this mess, we decided to go to Frank Partnoy, a law professor at the University of San Diego who's written a couple of books on the subject. Can you explain to me what a derivative is?
Yes, a derivative is a financial instrument whose value is based on something else. It's basically a side bet.
Think of it for a moment as a football game. Every week, the New York Giants take the field with hopes of getting back to the Super Bowl. If they do, they'll get more money and glory for the team and its owners. They have a direct investment in the game. But the people in the stands may also have a financial stake in the outcome in the form of a bet with a friend or a bookie.
We could call that a derivative. It's a side bet. We don't own the teams, but we have a bet based on the outcome. And that a lot of derivatives are bets based on the outcome of games of a sort. Not football games, but games in the markets.
Whether interest rates are going to go up or down?
Yes, and the new bet that arose over the last several years is a bet based on whether people will default on their mortgages.
And that was the bet that blew up Wall Street. The TNT was the collapse of the housing market and the failure of complicated mortgage securities that the big investment houses created and sold around the world. But the rocket fuel was the trillions of dollars in side bets on those mortgage securities called credit default swaps. They were essentially private insurance contracts that paid off if the investment went bad, but you didn't have to actually own the investment to collect on the insurance. If I thought certain mortgage securities were going to fail,
yes,
I could go out and buy insurance on them without actually owning them?
Yeah, the irony is, though, you're not really buying insurance at that point. You're just placing a bet.
Eric Dinello is the insurance superintendent for the state of New York. He says that credit default swaps were totally unregulated and that the big banks and investment houses that sold them didn't have to set aside any money to cover their potential losses and pay off their bets.
As the market began to seize up and as the market for the underlying obligations began to perform poorly, everybody wanted to get paid, had a right to get paid on those credit default swaps. And there was no there. There was no money behind the commitments, and people came up short. And so that's to a large extent what happened to Bear Stearns, Lehman Brothers, and the holding company of AIG.
In other words, 3 of the nation's largest financial institutions had made more bad bets than they could afford to pay off. Bear Stearns was sold to J.P. Morgan for pennies on the dollar, Lehman Brothers was allowed to go belly up, and AIG, considered too big to let fail, is on life support thanks to a $123 billion investment by U.S. taxpayers. It's legalized gambling.
It's legalized gambling. It was illegal gambling, and we made it legal gambling. And
with no regulatory controls.
With absolutely no regulatory controls. Zero, as far as I can tell.
I mean, it sounds a little like a bookie operation.
Yes, and it used to be illegal. It was very illegal 100 years ago.
In the early part of the 20th century, the streets of New York and other large cities were lined with gaming establishments called bucket shops, where people could place wagers on whether the price of stocks would go up or down without actually buying them. This unfettered speculation contributed to the panic and stock market crash of 1907, and state laws all over the country were enacted to ban them.
Big headlines, huge type, the front page of the New York Times.
No bucket shops for new law to hit.
So they'd already closed up because the law was coming. Here's a picture of one of them. and they were like parlors. See,
Betting parlor.
betting parlors. Yeah, it was a felony. Well, it was a felony when the law came into effect because it had brought down the market in 1907, and they said we're not going to let this happen again. And then 100 years later, in 2000, we rolled them all back.
A bill to reauthorize and amend the Commodity Exchange Act.
The vehicle for doing this was an obscure but critical piece of federal legislation called the Commodity Futures Modernization Act of 2000, and the bill was a big favorite of the financial industry it would eventually help destroy. It not only removed derivatives and credit default swaps from the purview of federal oversight. On page 262 of the legislation, Congress preempted the states from enforcing existing gambling and bucket shop laws against Wall Street. It makes it sound like they knew it was illegal.
I would agree. They did know it was illegal, or they knew it was prosecutable.
In retrospect, giving Wall Street immunity from state gambling laws and legalizing activity that had been banned for most of the 20th century should have given lawmakers pause. But on the last day and the last vote of the lame duck 106th Congress, Wall Street got what it wanted. The Senate passed the bill unanimously.
The Senate stands adjourned, sine die.
There was an awful lot of trust us, leave it alone, we can do it better than government, without any realistic understanding of the dangers involved. Can I get on the
Columbia University law professor Harvey Goldschmidt is a former commissioner and general counsel of the Securities and Exchange Commission. He says the bill was passed at the height of Wall Street and Washington's love affair with deregulation, an infatuation that was endorsed by President Clinton at the White House and encouraged by Federal Reserve Chairman Alan Greenspan.
That was the wildest and silliest period in many ways. Now, again, that's with hindsight, because the argument at the time was these are grown-ups, they're institutions with a great deal of money, government will only get in the way, fears it will be taken overseas, leave it alone. But it was a wrong-headed argument and turned out to be, of course, extraordinarily unwise.
What role did Alan Greenspan play in all of this?
Well, he made clear in his public speeches and book that a libertarian drive was part of the way he looked at the world. He's a very talented man, but that didn't take us where we had to be.
He was, another former commissioner told us, hard to argue with at that point.
Alan was the most powerful man in Washington in a real sense. Certainly a rival to the president, and had enormous influence on Capitol Hill.
And he was at the height of his power.
He was at the height of his power.
Within 8 years, unregulated derivatives and swaps helped produce the largest financial services economy the United States has ever had. Estimates of the market for credit default swaps grew from $100 billion to more than $50 trillion, and you could bet on anything from the solvency of local communities to the fate of General Motors. They also helped produce a huge transfer of private wealth to Wall Street traders and investment bankers who collected billions of dollars in bonuses. A lot of the money was made financing what seemed to be a never-ending housing boom, selling mortgage securities they thought were safe and credit default swaps they believed would never have to be paid off.
The credit default swaps was the key to what went wrong and what's created these enormous losses.
Is it your impression that people at the big Wall Street investment houses knew what was going on and knew the kind of risk that they were exposed to?
No, my impression is the contrary, that even at senior levels, they only vaguely understood the risks, they only vaguely followed what was going on, and when it tumbled, there was some genuine surprise, not only at the board level, where there wasn't enough oversight, but at senior management level.
They didn't know what was going on in part because credit default swaps were totally unregulated. No one knew how many there were or who owned them, and there was no central exchange or clearinghouse to keep track of all the bets and to hold the money to make sure they got paid off. Eventually, savvy investors figured out that the cheapest, most effective way to bet against the entire housing market was to buy credit default swaps. In effect, taking out inexpensive insurance policies that would pay off big when other people's mortgage investments went south.
I know people personally who have taken away more than $1 billion from having been on the right side of these transactions.
Jim Grant is the publisher of Grant's Interest Rate Observer and one of the country's foremost experts on credit markets.
If you can and you could lay down cents on the dollar to place a bet on the solvency of Wall Street, for example, as some did, when Wall Street became evidently insolvent, that cents on the dollar bet went up 30, 40, and 50-fold. Not everyone who did that wants to get his name in the paper, but there are some spectacularly rich people who came out of this.
Who got richer?
Who got richer, became fantastically richer.
A lot of them were hedge fund managers. John Paulson's Credit Opportunities Fund returned almost 600% last year, with Paulson pocketing a reported $3.7 billion. Bill Ackman of Pershing Square Capital Management said he plans to make hundreds of millions. Both declined our request for an interview.
It is a betting game, folks. It's a betting game.
Congress now seems shocked and outraged by the consequences of its decision 8 years ago to effectively deregulate swaps and derivatives.
This is casino capitalism. That's what it is. It's casino capitalism.
And various members of the House and Senate have all been the usual suspects to accept or share the blame.
Well, you're wrong. Credit default swaps, I think, have serious problems associated with them.
It appears to be the first step in a long process of restoring at least some of the regulations and safeguards that might have prevented or at least mitigated this disaster, after the damage has already been done. Where do we go from here?
We need the most dramatic rethinking of the regulatory scheme for financial markets since the New Deal. If anything has demonstrated that imperative, it's the economy right now and the tragic circumstances we're in.
How much danger is still out there, do you think?
We don't know. Part of the problem of the lack of transparency in these markets has been we don't really know.